Good evening, everybody. Happy Sunday to all of you. I hope you've had a wonderful weekend so far. It is a wonderful sunny day here north of Toronto. But let's get started. Lots to talk about when it comes to the market. Let's talk money. Let's talk Sunday market preview for the week. All right, everybody, let's get started because last week, volatility was absolutely insane. Taking a look at Friday, for example, where the Dow dropped 80 points. NASDAQ was down about 330, I think, and Toronto was down about 450. Unbelievable volatility to the downside on Thursday and Friday. And a lot of it has to do with the Fed, but we can't blame just the Fed because let's take a look at everything else. We have a cratering economy, both in the US and in Canada. We have inflation that's going absolutely out of control, both in the US and Canada. And in fact, it's a global problem. We have wages that are dropping. We have ongoing war. We have money printing. We have consumer debts hitting all-time highs. Are you surprised that the markets had a little bit of a pullback on Thursday and Friday? But let's continue to take a look at what happened because we had a couple big warnings, I guess you could say, between the Fed, the IMF, the World Bank. We had JP Morgan, Goldman Sachs. We had a bunch of people come out and give all kinds of warnings. But let's talk about the Feds because the Fed really came out last week. And again, they're pushing the whole scare or fear that they're going to increase the rates by 50 basis points. Now, the truth of the matter is we've known this for a while. We have known this for a while. In fact, you can blame the increase in the 10-year yield on the fact that we've known that they're going to increase about 50 basis points. So, in my opinion, the markets should be reacting a little bit calmer than they are since we already know that. Beyond that, what else did we get? They're going to continue to talk about trimming the balance sheet, which is absolutely not going to happen. And we can talk about that right now because JP Morgan came out and said, we are going to have an energy crisis, or we are in the midst of an energy crisis, and we need multiple billions of dollars in support. So where is that money going to come from? I'll tell you now, it's probably going to come from your pockets, taxpayer pockets, or the Fed. Fed's going to print, and they're going to continue to print and print and print. So as far as adjusting the balance sheet, it's absolutely not going to happen. They are not going to be doing any tapering. They may say they will, and they may even try it for a month before they have to pull back on that. Remember, this interest rate increase under Powell and tapering, this has already been done in the recent past. And what happened? They had to cut those interest rates back down and keep the markets going. But where is the market actually going to go? So last week we saw that little bit of a pullback. There is the potential here that we can go back and touch previous or test previous lows, and that would actually be in March. So if we can touch and bounce off March's lows, then we can actually see the markets potentially bouncing back. Truth of the matter is, if we drop below those levels, it's not a point of concern because we'll get to the 10-year yield later and my indicators that suggest that we're not near any kind of crash setup anytime soon. That being said, that doesn't mean the markets can't go lower. You just have to understand how your portfolio is going to work in these lower circumstances. So, for example, if you are a person who's managing their own individual stocks and managing their own accounts, then you want to make sure that you're properly hedged. If you're somebody who's in a mutual fund or ETF portfolio, then you're going to want to understand why you have these particular funds and the long-term strategy behind them. Because if you start to panic when the markets start to go down, you are surely going to lose your money. You are going to lose your savings because you're panic selling at a time where the markets may not justify a sale and move to potentially cash or try to shift into a safer market, even though where are you going to go? Into an interest-bearing account or into the money market? At which point, are you really positioning yourself properly? And you might, and it really depends on your portfolio. But at the end of the day, you really have to understand what you're doing with your portfolio. But we are, going back to the markets, we are probably going to come to test March's lows. But again, the 10-year yield, which barely moved on Friday, suggests that we're not near any kind of collapse. Remember, the markets are a derivative of the debt market. So if the debt markets remain stable and intact, the odds are the equities market will not collapse or go into any kind of major pullback. Again, you're going to see corrections, absolutely. That's normal in market conditions, but you're not going to necessarily see a collapse. But let's talk about the IMF now, because the IMF is actually downgrading the global growth outlook. Again, are you surprised? We have been talking about this for months, talking about the global outlook is going to be just as bad as domestic. So Canada, the US, yes, we know our outlooks are horrible. Looking globally, of course, they're going to follow suit. We have the same problems overseas that we have here. Wars, debts, energy crisis, food crisis, and we'll talk about some of the weird stuff regarding food crisis and in the US over this past little while. But they're under all the same stressors that we are here in North America. So, of course, the global outlook is going to be negative. The Fed, as I mentioned, they're going to be aggressive, supposedly, on their inflationary strategy here by raising the rates at 0.5 point. Now, keep in mind, the Fed, by their own admission, had stated that there will be an increase in inflation in the short and medium term. And the truth of the matter is, what people don't seem to understand, and I've said it before and I will repeat it again today, the rate of interest needs to exceed the rate of inflation to battle inflation. Otherwise, it will accelerate inflation to the upside. That's the truth. Now let's talk about JP Morgan. Again, they called for an energy crisis. They're looking for multi-billion dollars, saying it's going to be a multi-billion dollar problem. So again, more money printing. So that's not going to end. I'm not going to take this video too long today, but let's talk about the 10-year yield. The 10-year yield, are we at a risk of a crash? I've already talked about it. I say no, because the stability of the 10-year yield is indicating that's probably not going to happen, because again, the debt market will dictate when the equities markets will collapse. Not correct, collapse. And what we're going to be looking for is we're going to be looking for multiple days of 2, 3, 4% to the upside. And right now, we're not seeing that. We've had a few days where it has done that and some possible yellow flags, but as far as red flags are concerned, they're just not there. Now, going into this week, what can we expect? Well, we're going to continue to see inflation. We're still going to see some more earnings coming out. Recession, absolutely on the horizon. The way we see it is, as far as the Fed strategy is concerned, there's really only two options. They can allow inflation to continue to go to the upside, at which point nobody will be able to afford anything, and therefore the pressure will ease, markets will come back down to normal. Alternatively, they can continue to raise interest rates at a point that'll do nothing to inflation. Then inflation will go up, interest will go up, nobody will be able to afford anything. We'll enter a formal recession, even though we're already in a recession. We'll get into formal recession. Then the Fed will have to drop interest rates, allow the economy to recover. People have to find jobs somehow, if they're lucky to get anything, especially considering the shortages and everything else going on. And an economy doesn't just snap back. Only two strategies. We'll see which way the Fed wants to look. But the markets this week, I don't think they're going to really aggressively move to the upside. We may see some positives this week. I'm not really seeing a heck of a lot of major swings up. I would love to. I'd love to see we're going to, 2-3 days of 500-600 point increases, try to recover off the low from last week. Not sure that we're going to get that. As far as cryptocurrency is concerned, cryptocurrency is also under a little bit of pressure. Even if it does bounce, there's nothing really strong supportive to the upside at this point. So I'm not really sure on cryptocurrency there, although there is some positive news coming down the pipeline, at which point we'll focus on it then. Gold, silver, ideally we'd like to see that continue to move to the upside. However, under a lot of pressure after last week. But again, everything across the board was under a lot of pressure. So where are we going this week? I'm going to say it's going to be pretty volatile. I'm not sure we're going to see too much upside. Ideally, I'd like to say at least 2 days of up, 3 days down. But who knows what the market's going to hold, especially with all this volatility. Again, keep an eye on that 10-year yield. That's it, everybody. I will see you tomorrow morning at the opening bell.